Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, June 5th, 2012. And what I'd like to do today is a quick overview of the markets, look at a few different time frames, tell you what I'm seeing out there. As I've posted on the site recently, I can really make a case either way here. I think we're at a pretty important inflection point in the markets. But I'll go ahead and cover that. Let's start here on the daily time frame. We're looking at the chart of the SPY, the tracking ETF for the S&P 500. And as you can see here, and as I posted the other day, we finally hit the top of the target zone that I've been looking at for months now on both the SPY and the QQQ. So we hit that top of that target zone yesterday. Let's zoom in here a little bit and take a look at that. As you can see, we hit the top of that target zone and have bounced so far. I made mention that there's some positive divergence in place on the 60-minute charts. We're going to revisit those. But either way, this target zone, if you look back, we have a pretty good amount of support here, a lot of reaction lows there. So I feel that's a pretty solid, very important support area. And looking at the longer charts, I can make a case that we do go lower over time. The big question is, are we going to bounce first? And it is possible that we don't go lower from here. This could be the lows for 2012. Anything's possible in the market. But the current time, I am still leaning for more downside later on this year. But the important thing is what to do now. I've been personally more swing trading lately in my own account than active day trading. At times I will do either or, but I've pretty much swung a lot of the shorts that have been on the site down from the market peak, even back at this point here. And lately I've had a lot of the trade ideas on the site have hit one or more of their profit targets, and personally what I've been doing is taking profits on those, either reducing the position or taking full profits on those targets as they're hit. And in the last week or so here, I haven't been redeploying a lot of that cash back into shorts, and in fact I'm a little bit hedged up now. So we're looking at the SPY daily, and as you can see, we're at the top of that target zone. Let's jump all the way back to the monthly chart, and this is the big picture. I've talked recently about I did a comprehensive overview on this chart, so I won't spend too much time on that today. But as you can see here, the ROC, the rate of change 12, did give us a negative print last month, and this is the current month right here, and of course we're real early into June. We're at negative 3.59, but if we have a pretty solid close, especially a close below last month's reading, which was negative 3.43, that would be another very solid, very rare confirmed sell signal, longer term sell signal, and would likely portend more downside here in the markets. So we're looking at the big double top pattern. Prices rejected pretty hard. I had highlighted this potential channel setting up when prices were making a test of that upper trend line, and we did get a nice reaction off there that helps confirm, so far this is this yellow downtrend line is a valid line to watch. Alrighty, weekly chart. Again, this was all covered in the video recently at the recent highs in the markets. If you look at this highlighted uptrend line and the MACD and the RSI below, you'll see that the S&P the SPY put in negative divergence at the highs, and has so far come off quite a bit. And that may be all it needs to play out. But from my experience, when you have pretty solid divergences like this put in on a daily time frame, you're usually looking at more downside, both in time and price, than we've had so far. So it's possible the markets bounce here, maybe put in some type of bounce, come back to revisit those lows, maybe make a lower low. There are some support levels below, but that is for now my overriding opinion is that over time here in the next couple weeks to months, we'll probably see some more downside in the markets, even if we do have a bounce before then. Okay, let's take a look here at the 4-hour chart. This is a chart that's been posted many times, in the last couple weeks, a couple months here. We pretty much hit that target as well. That line came a little bit shy of it, but again, we made a perfect tag of that same level on the daily chart, at least the way I had the line drawn there. 60-minute chart. Let's zoom out to a 2-hour period. It shows it a little bit better. This T3 zone, from way back when we broke the top of this wedge up here, I've had these targets drawn, so for months now, going back to March or April, and this is another reason I'm looking for a possible bounce here. That was my favorite target all along, and we finally made, as you can see, a perfect kiss of that upper trend line here yesterday. And go back to the 60-minute chart here, and as you can see here, we've put in some positive divergence. Sometimes I've heard this referred to as flatline divergence. What you're looking at here on the MACD, we have perfectly even peak-to-peak lows. There's a straight horizontal line on those two lows on the MACD, but yet, as you can see here, price has made a much lower low against a flat MACD. So that is, at least in my book and some others, positive divergence. Sometimes you'll have, let's take a look at the Qs. This is your traditional positive divergence here on the MACD. Draw a trend line here, so you have a lower low in prices and a higher high on the MACD, which again, I did a video update a couple weeks back, and I know a lot of the sites out there, a lot of traders were getting bullish, looking for a bounce, and I figured that we probably wouldn't see one until we at least had some positive divergence on the 60-minute time frame. And now that we have that, that does greatly increase the odds that we can bounce here for a few days to possibly a few weeks or more. It's hard to really say how far this goes. And again, based on the longer term charts, it would not surprise me if something happened, especially out of Europe in the next few days or few weeks here. Everything's looking great in the markets. Let's say we start bouncing now. Bullishness starts increasing. We see stocks going up, and then boom. Some big event could really just take these markets down below that support level that we just caught and open the door up to some new selling. So I'm being very cautious here. I am trading the long side here for a bounce, and I do have stops in place below. Very possible that, and probably very likely, if we do fail here and take out the recent lows, it'll probably happen on an overnight gap, would be my guess. But again, that's what I'm seeing now. And if you look at, I had pointed out a few weeks back, there were quite a few bearish pennants. Here's a bearish pennant on the QQQs and bear flags, and it's pretty amazing. If you look at this line here, this is a technical projection, and you can see we hit that projection to literally the penny. And this is one other reason. I have columns, in my head, mental checklists, and this is another check for the bull side that we're going to get a bounce here. When you have technical patterns like this that measure out perfectly to their projections, and it coincides with support, which it has in this case, as I've illustrated on the SPY, and I'll go through this QQQ chart in a minute. But the way I do these, I just draw. This would be the flagpole on that pattern, and you draw it from the highs down here to the lowest point in the pattern, and then you add that to where it breaks down. So we have a perfectly played out bear flag pattern. 4-hour chart came a little bit shy of my 4-hour target. However, on the QQQs, I had a target zone here on the daily chart that went back and hit a few peak highs and some points in here. And if we zoom in, I believe I've already posted this chart, you can see we made almost a perfect tag at the top of that target zone. So again, another reason we may bounce here, because support has been hit, and I'm sure there were a lot of eyes on this support. If you go back, take a look, it goes back for several years. Alright, the QQQ weekly chart. I did a comprehensive video on this about a month ago on the Qs alone, and I'll probably put that up again. I think I had it buried, a small link to it buried in another post, but it made a good case why we were going to go down, and another reason longer term why I think we may have some more downside here, even if we do get a bounce that lasts for a few days or a few weeks. Let's see, these were the Fibonacci retracements off this big run that started back in December 19th. And again, when I know there were a lot of bottom catchers on the first part of the dip here, looking at such an extended move in the market, the reason I remained bearish throughout this whole thing, at least up at this point here, 23% retracement just wasn't going to do it. I was looking for at least a 38 to 50% or more. Ideally would be a 50 to 61.8% retracement off this huge move, and that's what we've gotten now. My fourth target zone, as you can see here, there's a dotted line, and that does line up perfectly with that 61.8% fib. The green horizontal lines that I use are based off horizontal support, price support. Okay, let's drill down, look at a couple key sectors, some that might look good for a bounce, but on the flip side, as I mentioned, the financials are really what have me concerned here. They are a lot of the big, especially the big too big to fail banks, are really at or just above some critical support levels. This is XLF, which is a compilation of a lot of different financials. You have some REITs in there, so it's not bank stocks alone. It's a whole bunch of a medley of different financial related stocks. And as you can see, here's my daily chart. XLF is at a very key, very solid support level. If you go back, this support zone here, you know, you have quite a few reaction, like a lot of candlestick reactions off that level, gaps in here. So this is a pretty key support level for XLF. And considering as much as we've fallen, there's a good chance we're going to bounce here. Now, one thing to take a look at, I have pointed out recently this bear flag pattern on XLF and a lot of the financial stocks, and that hasn't even come close to playing out. In fact, let's take a look at the 4-hour chart of XLF. There's the bear flag. This is a bear flag projection, and this is really the make or break, really key support. If we get below this lower line, it gets there's just a lot of thin air underneath that line there, so it's possible we go back down there. So I'm closely keeping an eye on this support zone. This lines up with that daily support zone that I just talked about. We found some pretty good support. We're getting a bounce here. But it would not surprise me one bit if these financial stocks, just as this bounce started looking really good, they turn back down, they break that support, and then start selling off very impulsively. So I am on the lookout for that, keeping it relatively light, although I do have some long hedges now and have taken profits on a lot of shorts. I have a pretty large cash position. This is just gambling right now to bet the long or short side too heavy here, in my opinion. So more nimble traders can maybe look for some hit and run opportunities, some balanced trades off support on the longs, but I would not stay too long at that party if I were you. XLK, this is the technology ETF. This has also been an active short trade idea, and as you can see, we're just pennies away from T4. As I always mention, I like to cover my shorts just before support, and I like to sell my longs just before resistance in order to get a fill. Now, I didn't have a position in XLK. I had quite a few individual technology shorts and some QQQ shorts. But if you were in this one, keep an eye on it here. Yeah, once you hit these target levels, the prior targets, which are support levels, will often act as resistance. So with XLK, you can look at this bearish flag, bear pennant. We could push all the way up to retest that somewhere in this area. We could stop here at T3. If you're swing trading that longer term, well, my final target's not much lower. So if you're in it, I personally would take full profits if we get back to T4. But you may want to tighten up the stops here if you haven't already done so. Either way, that's a sector that, along with the Qs, could put in a bounce because it pretty much hit its final target level. Okay, let's look at XRT. This is the retail ETF, and as you can see, again, positive divergence. Lower low on the price, equal lows on the MACD, so that positive or flat line divergence on the 60-minute chart. And again, like everything else I'm looking at here, it's at the top of a pretty key daily support range. Okay, this is the investment brokerage sector, which I did a video overview recently on. As you can see, we're only a few days out of breaking down from that bear flag pattern, which projects a lot lower, and also projects under this critical support level. This is a daily chart we're looking at. Take a look at 2-day. You can see some prior reaction lows here. Zoom out to a weekly chart, and this support level is the last stand for those stocks. There's literally no support below, and I find it very bearish that the investment brokerage sector. Let's just take a look at the market here. Let's take a look at the Qs, or well, let's look at the SPY. Here's a broad market. Here we are, 2009, March 2009 lows, and we're well off. We're over 100% above those lows. The SPY bottomed here around 67, and we're still around the 130 level, and yet the brokerage stocks are down, threading to make new all-time lows, as well as a lot of the banks. And let me jump back to that real quick. Why I talked a bit about XLF. I wanted to talk about the bank stocks. Here's Bank America. What jumps out at me on a lot of these key too big to fail stocks like Bank America and JP Morgan are the similarities of the patterns. I've been watching these for months, and it just amazes me that if you look at what these stocks looked like going just before the big financial meltdown in 2008, compared to what they look like now. Let's try to move this here. That's what things looked like before we fell off a cliff. There's the cliff right here, and and here we are today, a very similar pattern. So take it for what it's worth, and let's look at talk a little bit more about support. Bank America was a short a while back at this. This is a 2-day chart. I had posted as a short on the test of this downtrend line, and excuse me, folks, that worked out for quite a profitable trade, and we even fell below my final target T2. And if you look closely now, we've come back and retested that from beneath. So this was a pretty solid support level, in my opinion, which now is resistance, and we failed there. So this is another thing giving me pause here, that these big key stocks, they're at very precarious technical levels. They're still under. Unlike some of the other sectors I just highlighted, which were bouncing off some key support, and that is bullish. Overall, you want to see the broad markets bullish, but my worry is if something happens to one of these key too big to fail bank stocks, even a regional bank, one of the investment brokers, they're so intertwined that there would probably be a domino effect that would cascade throughout the whole banking and financial sector. So again, these are what's giving me pause here and keeping me from getting too bullish at this time. Here's JP Morgan, king of the financials, the biggest bank in the entire sector. And this one is just looking, again, not pretty. Look at that slide, and we know they had the big trading loss, which so far is only capped at $2 billion, but a lot of people think that that's going to prove to be a lot more than that down the road. Just like I remember when MF Global was having problems, the losses seem to grow throughout time. 2-day chart, as you can see, this level down here, the recent lows and the sell-off in the third quarter of last year, that would be the key support. This was the panic selling back in 08, 09. But JP Morgan is quickly approaching these levels, and that would be the technically speaking the final stand. And there is again a very similar pattern. And the other thing that strikes me is that the patterns put in off the 2009 lows are much larger. You're looking at this megaphone pattern that set up before the financial meltdown, and it was a good sized pattern. We're looking at a weekly chart here, and made a last touch up on the top of that pattern, and that was it. And then the meltdown came, and even though there were many more years building up, in the bull market preceding that top, this seems to be a much larger but very similar pattern, and we're seeing that very impulsive selling here at the end of what would appear like a mature pattern. We have 3 tags at the top, 3 on the bottom, and usually you only have 3, sometimes 2 below on a megaphone pattern. So either way, something to note. And then this is a 60-minute chart of JP Morgan. And again, this is why we might get a little bounce here. This is pretty strong divergence on the 60-minute chart. And with the XLF being at support, some of my favorite trades are when a sector and an individual stock line up for support. So if you look at JP Morgan, here's a nice falling wedge I've just drawn with positive divergence. So an upside break. Typically, you'd like to target the gaps. There's a gap right here, which would happen shortly after breakout. And I can put these charts up later. I'll try to give some targets on the long side if somebody wants to take these trades. And I do think they are relatively low risk longs as well, because we do have, once again, that key support just below. The XLF just found support. So if I were to go long JP Morgan here, a more conservative textbook trader would wait till a breakout of the pattern. I don't think there's anything wrong with establishing an initial position within the pattern here and a stop below the recent lows, or maybe not far. It may need one more push down before it breaks out, but I would have a stop not too far below current levels. And ideally, you want to buy at the bottom of this pattern. I wouldn't be too keen on taking it right here just before that uptrend line. I said a minute ago you could buy it in the pattern, but be better off maybe a pullback towards the middle of the pattern or the bottom of the pattern, because if you buy it here, you're buying just below a key resistance line, which is this moderate resistance line, this downtrend line here. Okay, this is IYT. This has been an active short trade from the break of this rising wedge. And just yesterday also hit my final target again, which I considered a pretty key support area. Hence the final target, just another reason why we could get a little bounce here. But of course, if that level goes, then that would be bullish. The trade's closed out, but if we do see a lot of these key support levels break, folks, I will be adding, and I may go ahead and add those some downside support levels or targets in advance, just in case we do wake up one morning to one of those 500 Dow point down days. I'll try to put up some downside targets soon. Here's XLE, the energy sector. Again, another stock that has come close, just a hair above a key support line. In fact, I probably could have moved that line up to this previous reaction low. So, yeah, consider the energy sector as having hit support. Positive divergence here. You can draw upsloping, slightly upsloping line here on the MACD against lower low in prices, and these are support lines that I've had on that chart. So yet another key sector. Here's XLB, the materials sector ETF, positive divergence on the 60-minute chart. And I will say on this one, on the daily chart, this is the support line that I've been watching on XLB, and we stopped well shy of it. But again, there is that 60-minute support. So if you were going to go along the basic materials, I would probably consider a stop. Ride any long side trades up with a relatively tight stop. This would be my recommendation, or place an initial stop not too far below the recent lows on these ETFs or individual stocks. Okay, and here's PBE, one of the biotech ETFs. There's several of them out there, and I have this downtrend line that I've drawn. Prices broke through earlier this year, which in itself was actually, I take that back. At the point in time, this was not a downtrend line because we didn't have any other points touching. I must have added this line recently, but it does look like it's had some reactions off there, and prices seem to be riding along this. And just a couple other stocks to mention. As I said, there are a lot of financial stocks that are really on the verge of make it or break it support. There's a group of stocks that I've traded on and off in the last few years. The insurance companies that market variable annuities. In my past life, I used to be a stockbroker and would sell various investment products. Some of those were variable annuities, which allow people to invest in the market, have the upside appreciation of the stock market, but yet there are guarantees on the downside, which the insurance company takes that risk on. So if you put in 100,000, you can ratchet up 6% a year if the market does 6% or better. There's a lot of variations to this, but the long end of it is if the bottom falls out of the market, as it did in 2008, and could again, these insurance companies have enormous losses that were never ever fathomed by their actuaries, who the bean counters that figure out statistically what their loss potential is. We had a rip-roaring bull market all the way up until 2000. We had a pretty decent bear market after that when the tech bubble burst, but that was dismissed as being just a once-in-a-lifetime bubble. And then we started on a new bull market. And so I can tell you there were tremendous amounts of dollars put into these variable annuities after that last bear market and after the last bubble burst. And these insurance companies are on the hooks for all those contracts. They cannot cancel those. They cannot renege on it. So there are still a lot of policyholders well underwater on their investments. And if the market takes another dive down, their liability just goes through the roof. So this is Manulife, one of the smaller companies, but they were quite active in the variable annuity market back a few years ago when I was in the business, and I believe they're still in the business. There's a downtrend line. This looks like sort of like a large descending triangle pattern, but most importantly, this is this level right here is your critical support level. Because this dip down here, that was a very temporary blurb during the meltdown, panic selling. But if you look on the volume at price histogram, there's pretty much no support below this line here. Another big one is Hartford. I know recently they were trying to sell off their variable annuity business. I don't know if they ever succeeded in that, but they were at the time the biggest player in the variable annuity business, and this is they're approaching a very critical level. Let's look at a 2-day chart. A move below that price, there's not a whole lot of support for Hartford. It would bring it back to a multi-year low. Another one that comes to mind is Prudential. Again, on a shelf of key support, multi-year support. We're looking at a 2-day period chart here that goes back to 2008. And actually, MetLife also dabbled around in the variable annuity business, so they have a lot of risk too. So where this comes into play, if we do see a big meltdown overseas that carries over into the U.S. markets, these variable annuity insurers are going to take a massive hit. They were bailed out by the government like a lot of financial companies back in the original the 2008-2009 crisis, but most people, myself included, don't think they're going to have such generous terms to a bailout. My guess is that the stockholders are going to end up eating the loss the next time around if there's a big turn down in the markets. Okay, finally, folks, to wrap this up and to try to be as balanced as possible, let's take a look. There are some great stocks out there that are at multi-year highs. We have this is Home Depot, looking very bullish. I'm looking at a weekly chart here. So from a monthly, even a weekly perspective, it looks pretty bullish. And Walmart, here's Walmart ripping out to a new all-time high. And we all know about Apple. Yes, Apple's had a little bit of a pullback, but still very bullish. So, you can take the glass half full thing, and what it boils down to is a lot of industries, tech, a lot of the retail stocks, they're healthy. There's no arguing that. So one could make a bullish case for the economy going forward. However, the Achilles heel will be the financials. If we see these financial stocks, especially some of these too big to fail banks, go down and break down those multi-year lows, if there's the crisis over in Europe continues to get worse and has some spillover here into this country, the financials will bring down the market, especially if the financial system, comes to I wouldn't say comes to a halt, but we experience a seize up or a clog up in the credit markets. That would definitely have an impact on just about any industry, any stock out there. So again, all eyes on the financial. And other than that, to summarize it, short term, I'm looking at a possible pop here. Could last a few days, as long as a few weeks, possibly more. This could, like I said, this could end up in hindsight, if everything blows away, being the lows for 2012. It's just way too early to call that. And we could also break these recent lows, the key support levels, and have a lot more downside on the market. But again, until that support level is broken, it's too early to make that call. So at this point, I am near-term bullish, cautiously bullish, I should say, and that can change at any moment. And I'll keep everybody posted. Okay, thank you, and have a good day.